Hey everyone, welcome back. About 18 months ago, I was in an investor presentation down in Texas, in the Houston area. We were pitching some of our investment opportunities at a dinner that we had hosted. And at the time, we were seeing mortgage rates in the high sevens, low eights. It was crazy. Treasury yields had spiked well north of 5%. And so when running through the pro formas, or the numbers on one of our pro formas, an investor raised their hand and asked, why would I take a cash-on-cash return of a few percent when I can earn 5% risk-free from the government? And, I had taken some finance classes in the past. And, this was a question we had entertained. And this was the first time I had been asked it in the real world, because for the last, I don't know how many years, you could barely make any money leaving your money in the bank or buying treasuries. And so it was one of the first times I really ran into it in a meaningful way, right? So when you're investing in real estate, the idea is that you need to make a premium over that risk-free rate, the money that you can loan the government to. So that's what the question I want to tackle today is, why would I invest in real estate at a 3% cash-on-cash return, hypothetically, when I can buy treasuries at 4% with no risk? And on the surface, it sounds logical. If I can get 4% from the U.S. government with zero headaches, why deal with tenants, repairs, property taxes, and uncertainty? So let's break it down, because the comparison isn't apples to apples. The first mistake that you make in that argument is comparing cash-on-cash return to a treasury yield. Treasuries give you yield. That's it. Real estate gives you cash flow, appreciation, loan amortization, tax advantages, rent growth, inflation protection. And so cash on cash is just the first layer. If you buy a property at a 3% cash on cash, it doesn't mean your total return is 3%. Let's say you're earning 3% in annual cash flow, rents grow 3% a year, the property appreciates 3 to 4% a year annually, your tenants are paying down your loan. Now your real annualized return over time could be 10% plus. Treasuries, still 4%. No leverage, no growth, no upside. So treasuries at 4%, they feel good until you remember inflation. If inflation averages 3%, your real return is about 1%, and that's before taxes. Real estate tends to adjust with inflation. Rents increase, property values adjust upward, replacement costs go up. Treasuries are fixed income. Real estate is inflation responsive. And in an environment where the dollar loses purchasing power over time, hard assets behave differently than treasuries. Treasuries don't let you use leverage in a meaningful way. Real estate does. If you buy a $400,000 property and you put 20% down, you control a $400,000 asset with $80,000. If that property appreciates 4%, that's $16,000 in value that you increased. On your $80,000 investment, it's a 20% appreciation return before even counting the cash flow. And that's that power of controlled leverage. Yeah, leverage adds risk. But when you use it responsibly in growing markets with a long-term hold strategy, it's one of the most powerful wealth-building tools available. Treasuries are a great short-term parking vehicle. I have some. If you need liquidity, especially if you're waiting 12 months, if you're capital preserving, but long-term wealth, historically, it hasn't been built on 4% fixed returns. It's been built on owning productive assets. So real estate requires patience and courage. And there's always uncertainty, rates and elections and recessions and headlines and wars in the Middle East. But here's the reality. Every 5-year window in modern history has felt uncertain while you were in it. And yet over 5, 10, 20, 30 years, disciplined real estate ownership has consistently created wealth. On the last episode, I talked about Logan Motoshami of Housing Wire's joke that you're going to die one day. It's happening. So do you want to park in treasury yields while that day inches closer and closer? Or do you want to actually do something? Don't get me wrong. Owning some treasuries for periods of time, it makes sense. Like I told you, I have some. But unless you've got absolute gobs and gobs of money, nobody ever got wealthy investing in treasuries. People say treasuries are risk-free. And technically, they are credit risk-free if you trust the U.S. government. Maybe that's another show. But they're not inflation risk-free, they're not opportunity cost risk-free, and they're not growth producing. Real estate has volatility, but when you buy in a strong job market with conservative underwriting, with fixed rate debt, And a long-term mindset, your biggest risk becomes inaction because time compounds growth and sitting still compounds very little. There's a psychological element here. It takes courage to invest when rates are higher than you'd like. Headlines are mixed and everyone's saying just wait. But historically, the best investments were made when things felt uncertain, not when everything was obvious. When things are obvious, they're already priced in. That's a treasury yield, right? You don't get paid for certainty, you get paid for discipline. A number of years ago, I owned a franchise that we bought houses, renovated them and sold them, or we assigned the contracts, various strategies to single family ownership. And when it comes to courage, I'm reminded of this funny story. I visited a house, and this old man, Don was his name, real name. I really took to Don. He was a great guy. He was a Vietnam vet. We traded stories. We talked. He was in a tough situation because he was just too old to maintain this house. And he was going to be going into a nursing home on his own free will. And he needed to get some money out of the house and had a lot of repairs. And I explained to him, hey, here's my offer. It's low because A, I got to put a bunch of money into it. I got to go to the market with it. And I've got to make a profit at the end of the day. You will do better if you hire a real estate agent and you take this out to the open market. Now, there's going to come a lot of other things that come with that. My offer is, hassle-free. You're done. It's over. And so he at the time, I believed, understood the kind of deal that we were doing. We wrote up a purchase agreement and he signed it. Well, my phone rang. I think it was the Monday or Tuesday because this was on a Friday, this visit. And Don said to me, hey, Steve, I'm feeling really nervous. I went to church. I told a few people about this deal that we're doing. And I had a bunch of people saying, I can't believe he's paying you. I think it was $91,000. This was obviously a while ago. $91,000. A bunch of people are saying they'd give me $120 in their sleep. They'd give me $120 tomorrow. I was annoyed. I liked Don. And I didn't want him to go into this deal feeling like we were doing a dirty deal, right? I wanted him to fully understand the risk and say, this is the best solution for me. So as annoyed as I was, that kind of won the day. And I said, I'll tell you what, Don, if you can get more money from somebody that goes to church with you and they can do it quick like I can, show me that they signed an agreement, they put the money in escrow, we'll tear up the contract, right? True story. And I said, so take a week, go back to church, talk to everybody, and, let's talk on Monday. And I thought, these people are, they're not going to do it. They're full of it. Everybody has a lot of bravado when we talk about real estate. But when it comes to actually doing it, especially when things are feeling a little uncertain, that bravado tends to disappear. And I bet you can guess. This is a rated PG-13 podcast for what I'm about to tell you. But my phone rang that Monday morning. And I remember picking up. I said, hey, Don. And he goes, well, Steve, you were right. They're all full of shit. I remember this story, a lot. And the point of it being, right, it's easy to talk big about real estate, but doing it, especially when things feel uncertain, it requires courage, right? So when you go into that deal, does it make sense today? Yeah, and yes, it's going to require a little courage. But if you use a growing market, use fixed rate debt, and you're patient, I think you're going to win. Thanks for joining. We'll catch you next time.